A minute ago, it looked like the economic story was going in one direction. Gas prices drifting down, stocks climbing, inflation easing, jobs supposedly holding up. The kind of numbers that, if you just glance at them, almost make you pause and think maybe things are stabilizing. And then, almost instantly, the picture flipped. Markets opened this morning and stocks started falling hard after the president announced there would be no deal to end the conflict with Iran unless there's unconditional surrender. Oil prices jumped right away. At the same time, a new jobs report landed that caught almost everyone off guard. The economy didn't add jobs last month. It lost 92,000. Analysts were expecting the opposite. Unemployment edged up to about 4.4%. So what looked like a manageable slowdown suddenly feels different. Not just a weak moment, but something darker. The way to think about it is this. The economy may be shifting from what people quietly called a recession into something closer to a wartime recession. Different labels, same direction, just heavier. We'll get into the labor market in detail in a bit, because the numbers there are strange. Private payroll data earlier in the month actually suggested hiring might be improving. Then the official report showed a massive drop instead. That kind of reversal doesn't usually happen without a reason. Administration officials are already offering explanations. One of them suggested the February numbers were distorted by winter weather. Ice storms. A few strikes on the West Coast that supposedly knocked 30 or 40,000 jobs out of the survey. Put that together, he says, and the weak report almost balances out. Maybe. But when you hear something like that, you start wondering about everything else happening at the same time. Immigration crackdowns shrinking parts of the workforce, supply chains adjusting to tariffs, rising consumer debt, housing prices pushing first-time buyers further and further out of reach, work requirements tightening around federal aid programs, disaster funding disappearing even as climate events hit states harder. And then there's the broader imbalance in spending. Roughly 10% of the population now accounts for half of all consumer spending in the country. So when someone says the job losses came from snowstorms, you pause. Before we circle back to employment, it helps to look at some of the deeper machinery underneath the economy, the parts most people never see. Because what shows up in headlines, jobs, inflation, markets, that's only the surface layer. Underneath, it is the financial plumbing. One place to watch is the repo market. It's essentially the overnight lending system that keeps financial institutions liquid so transactions settle smoothly. When everything is working normally, private lenders handle those short-term deals themselves. But if liquidity tightens or risk suddenly rises, the Federal Reserve steps in as a kind of backstop. And lately, that backstop has been appearing more often. Historically, the Fed might step in around quarter-end or year-end when transaction volumes spike. That's expected. But in recent months, there have been repeated interventions during ordinary weeks. Not seasonal pressure, just stress. A week ago, the Fed absorbed roughly $30 billion in overnight securities. This week, right as the conflict with Iran escalated, it stepped in again for another $9 billion. Those numbers don't show up in everyday headlines. But they're signals, quiet ones. Signals that something below the surface of the financial system may already be under strain. And when the deeper layers start showing stress at the same moment, the visible economy, jobs, prices, growth, is beginning to wobble, that's when things can move quickly, much faster than people expect. Now, when you look at the economy, most of the numbers people talk about, jobs, inflation, growth, those are the things you see above the surface. They're the headlines. They're what gets debated on television. But the deeper signals often come from places most people never hear about. And lately, those signals have been getting louder. For years, the financial system has operated in a very specific environment. High liquidity, relatively low interest rates. That combination allowed markets to absorb shocks that normally might have caused real damage. Tariffs, supply disruptions, technology shifts, even the threat of automation replacing jobs, those things could hit the system and it would wobble a little, but it kept moving. The cost of that resilience, of course, was often pushed onto consumers, onto middle-class families, onto workers whose wages didn't keep pace with asset prices. But the system itself kept functioning. Until recently, because now you're seeing several pressures arriving all at once. Labor market weakness, persistent inflation underneath the surface. And now, on top of that, an international conflict involving Iran that no one had really priced into the economic outlook this year. Energy prices were actually one of the few things keeping inflation numbers relatively contained. Oil had been weak, demand soft, supply strong. In fact, the market had been drifting towards something economists call contango, basically a mismatch between expectations of supply and demand that pushes future prices above current ones. Then the conflict started, and suddenly the energy market changed direction. Crude prices jumped far beyond the forecast people had been making just weeks earlier. A big reason is the disruption coming out of the Middle East, particularly around the Strait of Hormuz, where a large share of global oil shipments move every day. When that supply route tightens, even slightly, the entire pricing structure shifts. The global benchmark price, Brent crude, moved higher quickly. But something else interesting happened at the same time. U.S. crude, West Texas Intermediate, usually trades a few percent below Brent. That's normal. Different geography, different logistics. But in the past few days, WTI has climbed almost level with Brent. The two prices are now moving upward together, which raises an important question. Not just how high oil goes, but how long it stays there. A short spike, maybe a couple weeks, shows up mostly as noise. Gas prices jump at the pump. The monthly inflation numbers tick higher. And then the system settles again once supply stabilizes. But if elevated oil prices last several months, the story changes. Energy costs start working their way into transportation. Freight rates rise. Petrochemicals get more expensive. Plastics, manufacturing inputs, packaging, shipping, all of it slowly becomes more costly. And once those costs move through the supply chain, they begin to show up everywhere. Drivers see it first. Gas stations adjust prices quickly. They don't wait for economists to debate the data before changing the number on the sign outside. But official inflation statistics move slower. First, the change appears in headline energy inflation. Then, gradually, if the price shock lasts long enough, it spreads into core goods inflation. That's the dilemma central banks face. Is the oil spike just noise? A temporary disruption that lifts inflation for a moment but fades? Or is it a signal of something more persistent that forces interest rates to stay higher longer? If the conflict stretches into the summer, when energy demand is already high, that calculation becomes much harder. And while all of this is unfolding, another inflation signal quietly appeared this week in the import price index. This report measures the cost of goods entering the country, essentially the starting point of the inflation pipeline. January's numbers showed overall import prices rising about 0.2%. That doesn't sound dramatic, but the reason the number stayed low was falling fuel prices. Strip fuel out of the equation and the picture changes. Non-fuel imports jumped 0.5% in a single month and over 1% year over year. That means the underlying cost pressure on manufactured goods was already building even before the oil shock arrived. And when you combine that with recent increases in the producer price index, basically the prices businesses pay before goods ever reach consumers, you start to see the pattern. Inflation never really disappeared. It was just being masked by cheap energy. And once energy stops holding those numbers down, the pressure becomes visible again. That timing matters more than people realize. Because right now, millions of Americans are expecting tax refunds to start arriving. 4 months officials in Washington have been talking about those refunds as if there's some kind of economic reset button. The idea was simple. Once the money comes back to households, spending picks up and growth follows. It was one of the main talking points you heard over and over again. Wait for the refunds. Wait for the boost. No tax on tips. No tax on overtime. All of that was supposed to help restart momentum in the economy. But look a little closer and the story gets murkier. Tourism has been weakening in parts of the country, which means fewer tips for workers who depend on them. The overtime changes only applied to a limited share of overtime hours in the first place. And if companies are cutting back hours because demand is slowing, there's less overtime to tax or not tax anyway. So when those refunds show up, they may already be smaller than the ones people received a couple of years ago. And if inflation is heating up again at the same time, the extra money could disappear almost immediately through higher prices, which leaves you wondering whether the people making these economic promises are actually coordinating their policies or just speaking past each other. Another signal of how strange the moment is can be seen in the dollar. For a while, the U.S. currency had been weakening. That's not usually great for consumers because a weaker dollar reduces purchasing power abroad. Imported goods become more expensive. Travel costs more. In simple terms, your money doesn't stretch as far. But in the past few days, the dollar has started strengthening again. At first glance, that sounds positive. And in a narrow sense, it is. But the reason behind it tells you something about how global investors are thinking right now. When countries move closer to a wartime footing, markets start reevaluating what counts as safe. In many conflicts, the first reaction is almost automatic. Money moves toward the dollar and toward U.S. Treasury bonds. Investors want assets that are deep, liquid, and historically stable. That's exactly what appears to be happening. Capital is flowing into dollar-denominated assets again. Treasury yields along the short end of the curve have drifted down from their recent highs, but remain around the mid-3% range. The 10-year bond sits a little above 4%, high enough that investors still earn something holding it, but not so high that it signals panic. In other words, the bond market still views the dollar as the backbone of the global financial system, even as it quietly prepares for larger deficits and heavier military spending. But the rest of the market isn't nearly as calm. Equities have started rolling over. Investors are lowering expectations for growth, while also worrying that the Federal Reserve might delay interest rate cuts if oil keeps pushing headline inflation higher. So you end up with this split screen. On one side, global money rushing toward the dollar and treasury bonds because they're seen as safe. On the other side, riskier assets showing stress as investors brace for slower growth. And then there's an even stranger detail layered on top of all of it. Bitcoin actually rose after news of the conflict. Normally, you'd expect speculative assets to fall when geopolitical risk spikes. But the digital currency moved the other way, which hints at something unusual happening in investor psychology. Some traders appear to believe that in a world filled with sanctions, weaponized finance, and wartime spending, politically supported cryptocurrency could function as a kind of hedge against the traditional system. It's a strange moment where investors are simultaneously hiding inside the dollar and betting against the structures that make the dollar powerful in the first place. And that brings us back to the labor market, which might be the most confusing part of this entire picture. Because at the beginning of the month, the numbers actually looked decent. Private payroll data from ADP showed employers adding around 63,000 jobs in February. Analysts had expected closer to 48,000. So the report came in stronger than predicted. It was even described as the best month for private hiring since the middle of last year. Most of those gains showed up in education, healthcare services, and construction. Meanwhile, sectors like professional services and manufacturing lagged behind. At first glance, that seems like ordinary economic variation. But when you look closer, two uncomfortable patterns start to appear beneath those headline figures. The first one is where the job growth is happening. Healthcare continues to add workers at a steady pace. On paper, that sounds positive. Employment growth is employment growth. But economically, it doesn't function the same way as growth in sectors that produce goods or build long-term infrastructure. Healthcare expansion often reflects an aging population requiring more care. Resources flow into that system because demand rises with age and illness. That activity is necessary, obviously, but it doesn't necessarily generate the same kind of broad economic feedback where wages circulate back into new investment or large-scale production. Ideally, you'd see job gains spreading across areas like manufacturing or entry-level industries that bring younger workers into the labor force. Those sectors tend to create a stronger loop between income and economic growth. But that isn't where the hiring surge appeared. Construction numbers looked strong too, but when analysts broke those down further, they found something else. Much of the growth wasn't residential building or infrastructure projects. Instead, it was concentrated in non-residential construction tied largely to data centers. In other words, specialized facilities built for the expanding digital economy. Not housing that helps relieve supply shortages. Not broad infrastructure projects that ripple across the workforce. The second pattern hiding in the payroll numbers has to do with company size. When economists studied the hiring distribution, they found something that looks like a barbell. Job growth concentrated at the smallest businesses and the very largest corporations, with much less activity in the middle. At the top end, large companies often have advantages, capital, scale, purchasing power, that allow them to keep hiring even when conditions tighten. Those positions can pay well, and in a balanced economy that growth would normally spread outward through the labor market. But if the middle tier of businesses isn't expanding alongside them, something else is happening. Workers who can't access those higher-paying jobs may settle for lower wages at smaller companies simply because that's where opportunities exist. And the wage data supports that interpretation. Growth in pay has slowed for both workers who stay in their jobs and those who switch employers, which suggests the labor market is losing momentum. And that was the optimistic version of the story. Because shortly after the ADP report, the official government numbers arrived, and they told a very different story. Instead of adding jobs, the economy lost 92,000 in February. The unemployment rate ticked up to about 4.4%. The gap between expectations and reality was so wide it rattled both markets and policymakers. Officials have tried to frame the result as a one-month anomaly. Weather disruptions, temporary strikes, statistical noise. Maybe it will eventually be revised. But remember, this report followed a major revision to earlier data showing that job growth across the previous year had already been weaker than originally reported, the slowest expansion in more than 2 decades. Rebuilding momentum in the labor market from that position isn't simple. And there's one final detail that often gets overlooked when people talk about the unemployment rate. The headline number doesn't include people who've left the workforce entirely. It also counts anyone who worked even a single paid hour during the survey period. Gig work, short shifts, temporary assignments. All of that still qualifies as employment in the official data. So the deeper measure economists watch is participation. How many adults are actually part of the workforce at all? Right now, that number has started drifting downward. Population changes, immigration policy shifts, and long-term unemployment are all shaping the trend. The result is a workforce that isn't growing the way it once did. In fact, fewer people are participating while wage growth is slowing at the same time, which means purchasing power keeps eroding. And while all those warning lights are blinking across the economic dashboard, the country has stepped into a military conflict that could push energy prices higher and stretch federal spending even further. So the trajectory seems to be moving from a quiet recession towards something more severe. Unless, of course, you happen to own shares in a defense contractor.